Wanted to come at you with a video today about an option strategy that I know is a little bit confusing to some, but it's really not that complicated once you get into the meat of the definition of it, and that is straddles. Now, a straddle is an option strategy where you buy a call and a put, the same strike price, the same expiration date, and you know what? Let's slow it down and get into it. All right, let me bring up my handy notepad because I don't want to go too fast, even though I'm excited. Options talk gets me all juiced up. All right, so straddle. What is it? It's a call and a put. You buy them. I mean, you can sell them, but for this example, let's say we're doing a long straddle, right? So it's buying a call and a put at the same strike price with the same expiration date. Now, I know what you're saying. How does that make any sense? What is the, I buy calls because I think stonk go up, and I buy puts because I think stonk go down. So why would you buy both? I'm confused, right? So a straddle is profitable when the stock rises or falls from the strike price by more than the total amount that you paid. All right, so check it out. You buy a call option, it costs some amount. You buy a put option, it costs another amount. Those two amounts is a different amount, right? Let's say it's a nickel and a nickel, that's a dime. Yeah. And the option is profitable when the stock rises or falls by more than that dime. Don't worry, I'll give you an example. Your boy's got you. So when should I use a straddle? Boom. Why would you tell me about this kooky thing? And why does Tom use it? A straddle is a useful strategy when you're expecting a significant move in the underlying stock, but you're really not sure in the direction. So recent market conditions have not been kind to a lot of companies, and we're in the middle. Well, we're kind of at the tail end of earnings season, right? So a straddle is often used as a strategy ahead of earnings. You think, man, this stock's going to get crushed after earnings, but everyone thinks it's going to get crushed, so it could absolutely rip. How could I take, advantage of both sides of this? I think it's going to move in a huge direction, but I don't know which way. Maybe that's when the straddles come in. All right, so let's take it to a real world example of a straddle. We're going to do some math, which I personally hate. I'm going to have my calculator, even though it's small numbers. But let me show you in Thinkorswim really quick. So this is my 1 day, 1 minute chart of, let's see, what stock we're looking at. Ford. In Thinkorswim, Ford's one of my favorite stocks to trade. I don't really care about what the company does. I usually trade intraday. But let's take a look at how you would set up this straddle and how the pricing would affect everything. So I'm going to go over to my trade tab, which is going to bring up this option chain, and I know that you can't see it. I've gotten some feedback on these videos. So let's go to a little bit of a boo. Ooh, we're zooming in. Hi, even I'm bigger. All right. Oh gosh, I need to work on my skincare routine. Jeez. Okay, so this is the option chain for Ford. Obviously, the market's closed, so the options aren't changing in price. It's kind of why I do the videos at these times. It's just much easier for me. And Ford's last price, as you can see in the top right corner, I guess you can't see it, so I'll bring my level 2 box down, was $11.25, and that's what these options are trading off of, is that $11.25. So we're only a couple days till expiration, so the options on this are cheap. That's one of the reasons I like trading Ford on a weekly basis. So looking at the money call and put, looks like the 1150 is the at the money. So we're going to go to the 1150. We're going to right click on it. The left side of the chain is calls, right side is puts. I'm going to left click on it. You can do this on either side. And I'm going to go to buy. And this may be different on your brokerage. I'm not sure. I use Thinkorswim. Give your broker a call if you need help with this. Their customer service teams are always really awesome. And go down to straddle. I'm going to buy the straddle. That's going to bring up my trade box, which you can't see, so let's fix that. Woohoo. All right, so we have it here. We're going to buy. That's both options. The Ford 1150 call and the 1150 put. Now, that's going to cost me a total debit of 47 cents. Now, why 47 is because I'm paying, the calls are 11 by 12. They last went for 11 cents. And the 1150 put, are 34 by 37. They last went for 35 cents. So, well, 35 and a half and 11 and a half cents on the call. So we got 47 cents for the straddle at the 11.50 strike. So you're like, great, I have my call, I have my put. How do I make money? What's got to happen for me to make money on this, to go, on this straddle? So let's take it back to the chart. So 47 cents was our total debit, how much we paid for the straddle, and it's at the 11.50 strike. So let's go back to the chart. Pew. All right, we're going to bring up the calculator. I know it's simple math, but I want you guys to see it, and I'm bad at math. So we're at the 11.50 strike, right? That's what the strike we bought both our call and the put at, and it was 47 cents for the total call and put for the straddle position. So we're going to add 47, and that's $11.97. So let me draw a line on my chart right there. 11.97. Ooh, it's way up here. All right. Bam. There we go. And on the downside, we need to do the same thing, but we take that 11.50 and we subtract the total amount for the straddle, which was 47 cents. And that's $11.03. So let me draw a line at 11.03, which it's pretty close to. Bam. All right, so there's our straddle, right? And I guess it's called a straddle because of how it looks on either side of the option chain. You're on both sides of the chain. You're straddling it like a cowboy on a horse. Maybe that's a saddle? I don't know. That's not a thing. I'm sorry. So here's where we would need to be at 11.97 or greater above this blue line, or 11.03 and lower below this blue line, would put us in profit. So if we're above 11.97, our put would be worth 0, but the call that we own would be worth more than what we paid for the put to put us into profitability. That's very confusing, I know. And on the downside, if we're below 11.03, then our call option is going to be worth 0, right? But our put is going to be worth more than what we paid for this entire straddle. So down here, below 11.03, our call is 0. But since we paid 47 cents for the straddle, the put has gone more than 47. The put's now worth more than 47 cents. We're in profit. Conversely, on the upside, if we're up here at 11.97 and above, the put option is going to be worth 0, but our call option is going to be worth more than the 47 cents that we paid for the entire straddle. So you can see how this would be profitable based on a move in either direction, right? Here's another fun thing about straddles. You can use them to calculate an implied move of the stock based on option pricing. This is really helpful ahead of earnings. That's how they calculate like an implied move on earnings. I'm sure you may have seen sometimes experts or people on CNBC saying, hey, the market is predicting that this stock will move 5% on earnings. And you're like, how did they get there? You can do that using the at the money straddle like we have right now on Ford. I just defined it. It's 47 cents. That's the straddle, right? That's how much we paid for it. So, and then you can take your price of your straddle and you'd actually divide it by the current share price. So 11.25. What percent is that? 47 cents is what percent of 11.25, the current share price. And that's we'll multiply by 100 for the people who are simple like me. And that's a 4% move. So that would be the implied move by expiration of the underlying stock, in this case Ford. Now, it's not going to through earnings, but that is one way you can calculate an implied move on a stock ahead of earnings using the handy dandy straddle trade. Spread? I don't know. I don't know the official term for it. A straddle. Strategy? Straddle strategy? I don't know. Anyways, that's how you put together a straddle. That's what it is. Call, put, same strike price, same expiration date. It's got to go above or below how much you paid for both of those, and we will do our best to answer them. I hope this helped. If this was a little bit confusing, don't forget to rewind it and rewatch it again and again and again. And I love you, and I'll see you in the next video.